Hello everyone, welcome to ShailajaIAS. Welcome to the PYQ Decoder class of economy. This is class 2 of economy. Here we'll break down the micro themes where the 6 pillars I gave you, 6 to 7 important topics. We'll break down each topic one by one in the next coming 6 classes. So we'll start without wasting any time. Here the important themes I'm discussing is fiscal policy, budgeting and public finance, which are interlinked with the fiscal policy. Budget is linked with the fiscal policy, financing, taxation, all these are linked to the fiscal policy. So the theme which are interlinked with each other, this theme will be discussing. The last 5-6 years questions will be discussed and analyzed, decoded thoroughly. Come, we'll start with the first question. Okay. Capital receipts question on. Okay, all the terms should be clear. Basics. Okay, basic economic terms should be clear. So what is revenue, what is expenditure, what is capital, okay, what is capex, capital expenditure, revenue expenditure. Okay, all this should be clear. Revenue receipts, capital receipts, what are goods, what are services. Okay, questions are coming based on this terminologies itself. One question. Okay, what are the ways of calculating GDP? Okay, ways of calculating GDP, GNP, NNP, NDP, all these questions have come before. So economic basic terminologies are key that you have to remember. Based on that, questions are coming. So what are capital receipts? Based on that, 3 statements have been given. Capital receipts create a liability or cause a reduction in the asset of the government. Capital receipt is I am receiving money by selling capital asset. Asset is lost. If you sell your house, say you sell your house, which is a capital, okay, if you sell your house, or if you take a loan, that means liability. Loan is a liability because you have to give it back, right? Then you are generating the receipt, capital receipt, you are getting the income, but liability or loan is getting increased. Or say if you have a house and if you sell it, that asset, which house is an asset, is reduced. So in capital receipt, liability is created or asset is reduced. With respect to government we are talking, so this statement is correct. Borrowing and disinvestment are capital receipts. What is disinvestment? You have shares in the company. You are selling that shares. That means the asset you are reducing. The company you are selling, so asset is getting reduced. Borrowing creates liability, for example loan. So these are the example for capital receipts. When you do capital expenditure, what will happen? When you do capital expenditure, ulta, asset will be created. Asset will be created when you do capital expenditure and liability will be reduced. Liability reduced. Ulta in capital expenditure. Clear? In capital receipts, however, what happens? Liability will increase, asset will reduce. Statement 1 is right, statement 2 is right. Have conceptual clarity. Borrowings and disinvestment are capital receipts. Same thing, matching logically. See, borrowings, reduction in the asset, create a liability. Is borrowing a liability? Yes. Statement 1 match with statement 2. Reduction in asset, disinvestment. Okay, you are selling your shares in the company. Is it reduction in asset? Yes, you are selling the company shares. So, is matching statement 1 with statement 2. Logically deduce it. Both statements are correct? Yes. Interest received on loans create a liability of the government. Loans, say government has given loan to other government or some other corporate bodies. Okay, then it is receiving interest. Is it a liability, this loan, or an asset? I have given a loan to other person and he is paying me interest for that loan. Okay, that loan is an asset for me, not liability. Why? Because I am receiving interest income as well as the principal income I'll receive back. So whenever banks are giving loan, those are asset, and when banks are taking deposits, those are liability. If the third person, if the person whom I have given loan doesn't pay me back, then it will become non-performing asset. In banks you have heard, right? NPA, non-performing asset. That means the loan which you have given is defaulted and it is not getting paid back. That will become non-performing asset. So here interest received is not a liability, but it is an asset. Loan is an asset and interest received is it capital receipt or revenue receipt? You should have all clarity. This is revenue receipt, interest received by the government. Statement 3 is wrong, statement 1 is right, and statement 2 is corollary to statement 1. Therefore, 2 pairs, which is option A, 1 and 2 only. So, interest received is a revenue receipt. Capital receipts either create liability or reduce an asset. And capital expenditure, ulta. Okay, understood? We'll go to next question. This is about the terminologies used in budget. This was asked again in 2025. The terms like revenue deficit, fiscal deficit, primary deficit, FRBM Act, all this becomes very, very important. The themes again are asked in a different way, but concepts are clear. You can answer any question. So here the question is given, revenue expenditure is 80,000 crores, revenue receipts is 60,000 crores, borrowing, total government borrowing is 10,000 crores, interest paid is 6,000 crores. So here, which are the correct statement he has asked? Revenue deficit. Revenue deficit is revenue expenditure minus revenue receipt. 80 minus 60k, 20,000 crores. Yes, statement 1 is correct. Fiscal deficit is 10,000 crores. Fiscal deficit is also the total borrowing of the government. Here borrowing is given, directly as given. Then primary deficit is, what is primary deficit? Fiscal deficit minus the interest paid for the previous loan. So 10,000 minus 6,000 crores is 4,000 crores. We all know fiscal deficit, is also the borrowing that the government has done. Revenue deficit direct, primary deficit is fiscal deficit minus the interest paid for the previous year loan. So all 3 statements are correct here. 1, 2, 3. Right? So here option D, 1, 2, 3, all are correct. Clear? You should have clarity on all this, then only economy will be able to answer. Gross primary deficit. Next question has been asked in 2025 again. See on the terminologies only. You can study 1,000 pages, but if you don't have clarity on the concepts, it will be very difficult to answer. Gross primary deficit. A country's fiscal deficit, again, at 50,000 crores. It is receiving 10,000 crores through non-debt creating capital receipts. Okay. The country's interest liabilities are rupees 1,500 crores. What is the gross primary deficit? What is primary deficit or gross primary deficit? This is equal to fiscal deficit minus interest paid, right? Minus interest paid or interest liability. Already we saw in this one. Okay, last slide, last question, same question has been asked. Here he has just added one more fact to just create confusion in our brains. So now here it is nothing but 50,000 crores minus the interest liabilities will be the gross primary deficit, which is 48,500 crores. These are the levels of question and understanding needed where questions are coming from basic concepts. That should be clear. The foundation should be clear. So here answer is 48,500 500 crores. Next, 15 Finance Commission. In 2024 also question had come, 23 also question had come on Finance Commission. We'll see one by one. What is the mandate of 15 Finance Commission question has been asked. First one, recommended grants of rupees 4,800 crores for educational outcomes. Even if you don't know. Okay, we'll see. 45% net proceeds shared with states. After creation of Jammu and Kashmir plus Ladakh Union Territory, it was reduced. The share was reduced from 42% to 41%. So that the 1% will go to there. Obviously, this fact is a wrong. You need to know few of the important things that are happening in Finance Commission and the recommendation of the Finance Commission, how devolution is happening. So statement 2 is wrong. Then statement 3, 45,000 crore for agriculture reforms. Then reintroduce tax effort criteria. Obviously, 15 Commission, Finance Commission is a very important, okay, key current affairs topic also. And even if you don't know all, and if you know that it was 42% and it reduced to 41%, you can arrive at the answer. If statement 2 is wrong, 2 is wrong, 2 is wrong, 2 is wrong, only C 1, 3, 4. This is where elimination work. If statement 1 statement, if you know it is wrong, and if that statement is in all the option, you can eliminate. But if pairs are given, and if you don't know all proper facts, how much for the education, how much for the agriculture reform, then it will be difficult whether 2 pair or 3 pair or 1 pair. But here, since you can eliminate, you can arrive at the answer 1, 3 and 4. Answer C. Clear, my friends? Next. The union budget again asked in 2024. 3 to 4 questions repeat in this unit, this theme every year. Union Finance Minister on behalf of Prime Minister lays annual financial statement. Okay, this was discussed in polity also. Here the swap is happening. Authority swap is a key trap kept by UPSC. The Union Finance Minister on behalf of Prime Minister or President? It is President, right? Not Prime Minister. So statement 1 is wrong. Article 112 speaks about Union budget. It's also called annual financial statement. Next, at the Union level, no demand for grant can be made except on the recommendation of the President of India. This is correct under Article 113. No demand for grants can be made except under the recommendation of President. So here option is B. Answer B. Statement 2 is only correct. Clear? Easy question on budget. 23. Tax devolution was asked again with respect to Finance Commission. Demographic performance, forest and ecology, governance reform, stable government, and tax and fiscal effect. Demographic performance, yes. Forest and ecology, yes. Governance reform, stable government, okay. And tax and fiscal effects, yes. These are 2 criteria which are not there in the Finance Commission criteria. Now, in the next Finance Commission criteria has been changed. That question also has been asked in the previous slide we saw. That becomes very important. You study thoroughly with respect to Finance Commission. Both the 15th Finance Commission with respect to chairman, with respect to new features, all that becomes very important, and the upcoming Finance Commission also. So here is option is only 3. Option B. Clear? Next, we'll see indirect transfers. This was also in news linked to static topic. Indirect transfers mechanism. Which of the following best reflects indirect transfers? Often talked about in media recently with reference to India. Say you have not read anything about indirect transfer in economy directly, and current affairs also have not seen how to answer. Indirect. Sometimes the terms will have the answers. Indirect transfers. Indian company investing abroad. foreign company paying tax at base. Selling tangible foreign assets. Foreign shares deriving value from India. Foreign shares deriving value from India. That means assets are in India. All your assets, operations are in India. Company, okay? Company is in foreign value, in foreign country. To escape tax, what company is doing, okay, the shares of the company or the company will be located in foreign country. However, the assets of the company and the revenue is generated here. That was a case with respect to Vodafone. Indirect transfer. Foreign shares deriving value from India or Indian assets. Indirectly, company is benefiting from Indian assets and revenue it is taking, and it doesn't want to pay tax in India. This is linked with indirect transfers. Okay, very difficult in the examination all if you don't know anything about this at all. But if you have read anywhere, if you have know the concept of what are indirect transfer, and it is telling that it is recently mentioned in media, talked about in the media, the case. Okay, that will be a case or talked about when there is buzz. All these things you see which are having buzz. Indian company investing abroad. Is there anything? Foreign company paying tax at base. Okay, selling tangible foreign assets. Here, foreign shares deriving value from India. That means they are trying to avoid tax and indirectly they are transferring the money from Indian assets to the foreign company. This was a case, okay, with respect to Indian assets in the Vodafone Hutchinson tax case. Clear? We'll see next question. Capex versus revenue expenditure. Again, the question was asked in 22. Again, the question came in 25, right? Acquiring new technology is a capital expenditure. Under the definition of capital expenditure, yes, acquiring new technology is a capital expenditure. For example, AI, machine learning, robotics, what is capital? Capital which helps in the production, right? Which helps in the production without itself getting consumed. Okay. Operational things or raw material will get consumed. However, capex and capital will not be consumed and it will be durable. So, acquiring new technology is considered capital expenditure. Debt financing is considered capital expenditure, while equity financing is considered revenue expenditure. What is debt financing? To finance yourself, you are taking a debt or loan. For example, to run a company, you are taking a loan. Or equity financing, to run a company, you are giving shares or equity. Normally you see startups, right? Startups, if doesn't have revenue, what they do? They sell their shares to the investors. They sell their shares or equity to the investors. These are considered revenue expenditure or capital expenditure. Tell me, when you sell your company, is it revenue expenditure or capital expenditure? It's not revenue, it is capital expenditure. Okay, debt and equity finances are source of funds here, not expenditures also. Why? Because you are receiving money. Here, debt financing, loan, it is receipt because you are selling something and taking money. Of course, it is creating liability. Here also you are selling equity and you are getting money. So it is receipt and it is capital receipt, not revenue receipt. And it is not expenditure. It is not revenue expenditure. Both are capital receipts. Okay. Not types of expenditure. Clear? Here again asked in 22. Again with respect to capex, revenue expenditure definitions terms asked in 25. Now with respect to borrowings, questions has been asked. A share of the household financial savings goes towards government borrowings. Is it correct? Households, okay, all their savings, yes, government can take that as borrowing. Your PFs, okay, in post offices, all this can be indirectly used by government. Of course, statement 1 is right. Dated securities issued at market-related rates in auction form a large component of internal debt. You should have clarity of how much internal debt and how much external debt is there. And dated security issued by whom? RBI. At market-related rates. Okay. Repo, reverse repo, all these terms also become very important. Form a large component, okay, under e-Kuber platform. There's a e-Kuber platform of RBI where this market, okay, dated securities can be auctioned. How much it forms? Almost it is hovering about 75 to 77% of our internal debt is with respect to dated securities. Obviously, this is also correct. A large component is not telling, it forms 90%. It's not giving fact. UPSC, okay, will keep a trap like this. 90%. It will be around 75 to 77%. When it says a large component, generally it is correct. But you should have the idea that internal debt is more than external debt. In internal debt, dated security forms almost 3/4 of the total debt. Total internal debt. So statement 1 is right and statement 2 is right. Both statements are correct. Okay. Carry coupon rate auctioned by RBI and it is in e-Kuber platform forming the bulk of the internal debt. Clear? We'll see the next question. This is with respect to creation of black money and the fiscal impact of the black money. It was asked in 2021 with respect to tax. Okay, tax effort also becomes very important. Under fiscal policy, taxation, budget, okay, banking, mechanisms of creating, okay, taking loans, that all becomes government debts, government expenditure becomes very important. Which of the following effect of creation of black money in India has been the main cause of worry to government of India? Diversion to real estate, yes, black money will happen. Investment in precious stones, yes, they'll use the black money there. Donation to political party, yes. Loss of revenue due to tax evasion. In UPSC, okay, you have to find the best answer. Here, all are true with respect to black money. But black money, what is the main important thing it creates is parallel economy. And parallel economy, it is outside the area of government. So what happens? The parallel economy, the money here will never go through the government system. That means the loss of exchequer and revenue due to the tax evasion is the biggest threat. Okay? Which of the following effect in India has been the main cause of worry is tax evasion. How many people pay direct taxes in India? What is the tax base? Study all this. What is the tax base? Okay, direct tax. What is the base in India? Very less people, okay, pay the tax base. That you have to know. If you see direct, indirect tax and GDP, there are some of the sectors of economy where it is still informal, which you cannot take into account also. There easily black money can go and the revenue can be out of the system of India, which will affect the loss of revenue, development, economic cycle as a whole will be affected due to black money. Clear? Next, inflationary effect on finance. Which of the following is likely to be most inflationary in effects? What is inflation? You should know. Okay, rise in general level of price of majority of goods and services. Okay, general price increase. General price increase of the goods and services, okay, is called inflation. Normally, inflationary effects of finance. That means inflation is increasing due to financial policy or fiscal policy. Which is the most inflationary is asking here. Repayment of public debt. That means whatever public debt is there, that is repaid back. If money is paid back, you don't have money. If you don't have money, then you can't buy things. Here, actually inflation will reduce. So this is not. Borrowing from public. Borrowing will take the money from public to the government. Public to the government. That also will have inflationary effect of finance. Yes, government when it borrows money, it can spend on it, but borrowing itself will not create inflation. This is also wrong. Borrowing from banks. Borrowing from banks, yes, money is going to government from banks, but this is also not very inflationary because government has to pay back. Creation of new money. That is, government will tell RBI to just simply print new money. When it prints new money, goods and services are same. Goods and services remain same, but money is increasing. When money is increasing, without the increase in goods and services, then what happens? Inflationary service, inflation will increase and it will not match to the goods and services, and the cost of goods and services rise automatically. So which is the very, very high inflationary causing effect here? Statement 4, creation of new money. So monetization of debt increases money supply without increasing goods and services. All this taking loan from bank, from public, will not cause much inflation compared to creation of new money, simply because this has to be paid back, and once you pay back, the inflation will be settling to itself. But here creation of new money, what happens? Goods and services are same, but supply is more, therefore inflation increases. So these were the questions asked in this topic, and this topic forms the foundation, the base. So study well, revise well. All the macro themes which I have asked are which I have given here are where questions have been coming every year. So revise on these themes, interlink and study properly. Till then, see you in the next class. Take care.